This is your LMAX exchange technical update for Wednesday, February 15th, 2017. Euro dollar. So the euro continues to extend its declines after closing below 106.20. We talked about this level being a key level of support, and the establishment below now suggests that the market is ready to roll over for a retest back towards that 14-year low from January at 103.41, which guards against more significant support in the form of parity further down. At this point, it would take a break back above recent resistance around 107.15 at a minimum to take the immediate pressure off the downside. Sterling dollar. So cable has mostly been chopping around over the past few sessions, and the market is unable to determine which way it wants to head next. But overall, it's important to note that the downtrend here remains firmly intact while the market holds below that December peak at 127.75. And so the greater risk is for a downside break. If we see a break back below last week's low, which came in around 123.47, that would do a good job of strengthening the bearish outlook and accelerating declines back down towards the base, which comes in the form of that 118.41 October plus 30-year low. Dollar yen. So dollar yen has seen a nice little bounce over the past few sessions, but overall, despite this bounce, the pressure does still remain on the downside while the market holds below that high that we saw back on the 19th of January at 115.62. And so the market could stall out easily again ahead of 115.62 in favor of the next major downside extension below 111.59, recent support, and towards a measured move objective at 109.50 further down. Again, only back above 115.62 will put the pressure back on the top side. Euro Swiss. So Euro Swiss has been forever waiting to break down below that 2016 base at 106.24. A break below that level will almost certainly expose a direct retest of the psychological barriers at 105. At this point, if we do see any rallies, they should be very well capped ahead of 107.60, with only a break back above that level to compromise the bearish outlook for Euro Swiss. Aussie dollar. So Aussie continues to show signs of wanting to top out after the market has been unable to establish above 7,700 in recent trade. We saw the market attempt to break above 77 back in early February and once again tried to do so on Tuesday trade, but stalled just shy of the barrier, matching that early February high at 76.97 and reversing lower. But we would need to see a break back below recent support at 76.05 to take the immediate pressure off the top side and strengthen the possibility for a bearish shift in this market, exposing deeper setbacks. So again, there is risk for the market to roll over, but it needs to establish below 76.05 to strengthen that outlook. Only back above 78 would compromise the topish outlook for Aussie, though, with the market coming into some significant resistance in the 77 to 78 area, which is medium-term resistance following a very impressive run in 2017. Dollar CAD. So dollar CAD has seen some setbacks in recent trade that have extended below psychological barriers at 130, but the inability for the market to establish below 130 does suggest that we could see a base here ahead of the next major upside extension. We would need to see a break back above recent highs around 132.13 to confirm this shift back to the top side and accelerate gains. Ultimately, a close back below 29.69 or a close even below 130 would compromise the immediate constructive outlook for dollar CAD. Kiwi dollar. So Kiwi continues to show signs of topping out, putting in a major top after stalling out in 2016, just ahead of 75, and now in 2017 ahead of 74. There's risk for these setbacks to now accelerate back down towards medium-term support, which comes in the 68.60 area, below which would expose more significant support down, going back to all the way back to May of 2016 at 66.76. Only back above 75 would compromise this more significant topish outlook for Kiwi dollar. SPX 500. The S&P 500 has been relentless, pushing up every day to a fresh record high. The market is now approaching next key psychological barriers at 2350, and it would take now at a minimum a break and close back below some previous resistance turned support at 2304. That's the high on the 26th of January to take the immediate short-term pressure off the top side. Overall, though, we would need to see a break all the way back down below 2232. That's the low that we saw on the 30th of December to force a more meaningful shift in the structure. Until then, any setbacks should continue to be very well supported in continuation of this intense uptrend in the S&P 500 to fresh record highs. Gold. So gold has been very constructive of late. The market had been supported several days back at 1180, taking out resistance at 1220 to set the stage for this next major upside extension towards a measured move at 1260. At this point, any setback should be very well supported, with only a break back below 1180 to compromise this constructive outlook for the gold market.